Welcome to Big Picture Earnings Analysis. We are jumping straight into a real head-scratcher today with Signet Jewelers, ticker SIG. Their third quarter results came out, and they were, just a massive, undeniable beat.
Completely blew the forecasts away, but then the stock dipped right after.
That's the paradox.
Exactly. So what we're going to do is unpack that amazing Q3, but then pivot fast to the cautious forward guidance that really spooked the market.
Okay, let's start with the beat because these numbers are pretty startling. Adjusted earnings per share. Analysts were looking for maybe 24 cents.
Right.
They came in at 63 cents. That's a 162% surprise.
It's huge. And revenue was solid, too. $1.4 billion, just a little over the $1.36 billion they were expecting.
But the number you really want to watch for a retailer is same-store sales.
Always. And it was up 3%.
And that's the key, right? This isn't just a one-off. It's their third straight quarter of positive SSS growth. It shows momentum.
It shows the strategy is working. And it wasn't just, high prices. This was efficiency. Their adjusted operating income actually doubled year over year.
Doubled?
To $32 million. And the big one for me, the gross margin rate expanded by 130 basis points. That shows real pricing power.
And was that across the board, or was it really their big brands carrying the load?
It was concentrated right where you'd want it to be. Kay, Zales, and Jared. Together, they delivered 6% same-store sales growth.
Wow.
So their core high-visibility brands are absolutely firing on all cylinders.
Okay, so just to recap, Signet crushes the numbers, doubles operating income, shows positive momentum. Their key brands are flying.
And the stock falls.
The stock falls 3.8% pre-market. This is where it gets confusing.
Well, this is a classic case of the market looking forward, not back.
Yeah.
And you have to look at the context of their valuation.
The PE ratio.
Right. It's hovering around 31, 32.
Okay, let's pause there. Because a 31 PE for a jeweler that's not a value stock. The market is pricing them for serious growth.
You absolutely nailed it. That valuation assumes their big transformation keeps paying off. It assumes continued high margin growth. So when management signals any kind of caution,
It threatens that entire growth story.
instantly, any hiccup, and that multiple looks way too high.
And that hiccup came in the Q4 guidance. Let's get into the specifics because this is what caused the sell-off.
The range for Q4 same-store sales is just incredibly wide. It signals huge uncertainty.
It's from a 5% decline on the low end,
A pretty sharp drop.
all the way up to a tiny 0.5% increase.
Right.
They're basically saying, we have no idea what the consumer's going to do.
Exactly. Now, to be fair, they did raise the low end of their full-year forecast a bit.
Right. For the full year EPS, the range is now 843 to 959. So they tightened it up from the bottom.
But the caution is what the market heard. Management talked about external disruptions since late October. They specifically mentioned softness among mid to lower income customers.
And analysts were asking about things like a potential government shutdown, right?
Yeah.
Or SNAP benefits.
Yeah, these aren't just vague fears. They're seeing real-world data in their stores that suggests a portion of their customer base is getting squeezed.
All right, let's pivot from that external fear back to the internal excellence. Because Q3 happened despite inflation, despite everything. How did they pull it off?
It really all comes down to just incredible operational discipline, especially on pricing and margins. They call it the art and science of retail.
So what does that actually mean?
It means they expanded their merchandise margin by 80 basis points, and that expansion was like a shield. It protected them from higher gold costs and those massive tariffs we'll get to.
The gold costs are always a factor.
Yeah.
How do you pass that on to a consumer who's looking for a holiday gift at a specific price point?
It's tricky. For, a big-ticket gold item, the customer sort of gets it. They know gold has value. The real art is engineering the core gift items.
To make sure you still have something good under $500.
Precisely.
Yeah.
You have to be smart about design, materials, everything to hit those magic price points. And they got much smarter with promotions. Jared, for instance, cut its discounting by 25% compared to last year.
That's huge for the brand's health.
It is. Promotion becomes a scalpel, not a sledgehammer.
And it wasn't just pricing. The actual products they sold changed a lot. Average unit retail was up 7%.
And that brings us to the biggest trend in the entire industry, lab-grown diamonds.
LGDs.
They are central to everything Signet is doing right now. Penetration is up dramatically. In their bridal business, which is their foundation, LGDs are now roughly 40% of sales.
40%.
And in fashion, where they see all this growth, it's at 15%, which is basically double what it was last year.
So is the strategy here just to offer a bigger diamond for the same price? How does this actually help their business long term?
Well, that's the key question, isn't it? In the short term, it absolutely drives up that average unit retail because the customer gets more perceived value. It gets them in the door.
And it secures the sale.
Right. And Signet's scale gives them a huge advantage. They can source and integrate LGDs way more efficiently than a small independent jeweler can. They're using LGDs to redefine value and lock in that mass market consumer.
And they did all of this while keeping inventory super tight. It was actually down 1% year over year.
Which is incredible when you think about the higher cost of gold and those tariffs.
Okay, we have to talk about the tariffs. The India tariffs went from 5% to over 50%. That sounds like a potential disaster.
It could have been catastrophic. I mean, a 45-point jump in costs overnight it's a nightmare scenario.
So how did they mitigate, as they said, the majority of that? Moving production sounds way too simple.
It was a full-on emergency re-engineering of their supply chain. They had to leverage their global scale to move huge amounts of manufacturing to places like Vietnam and Thailand, and they even ramped up their own U.S. production.
So they basically did a multi-year diversification plan in a few months.
In a few months. It was a masterclass in logistics and nimbleness.
That agility is really impressive. But the market isn't looking at that. It's looking at that Q4 guidance range. What specifically is driving that caution?
It's traffic. Plain and simple. It was softer in the 5 weeks before the earnings call, and the softness is very specific.
It's hitting the lower and middle income households harder.
Exactly. This connects right back to those analyst questions. Signet has incredible data from their credit portfolio and local sales. They can see the stress points. They know their core customer is feeling fragile heading into the holidays.
And for jewelry, the holiday season is. It's a different beast than for general retail. Black Friday isn't the main event.
Not even close. You know, management was very clear on the call. Black Friday to Cyber Monday, it's a small part of their quarter.
It's all about the last 10 days before Christmas.
Everything hinges on that final sprint. That short period is bigger, volume-wise, than the entire month of November. The pressure is on.
And they admit they got it wrong last year. They didn't have the right inventory.
They did. They learned a very painful lesson. They were way too light on LGD fashion, and they didn't have enough depth in those crucial sub-$500 and sub-$1,000 price points.
So what's the fix this year? How big of a change are we talking about?
It's a full-scale value offensive. They said they are anywhere from 5 to 8 times deeper in inventory in those key price buckets.
5 to 8 times.
Yeah. They made a massive calculated bet on LGD fashion under $1,000. They are determined not to miss those sales again.
And it's not just product. They're also optimizing their actual stores. Right?
Yes.
Moving out of dying malls.
Absolutely. Their refresh program for Kay, Jared, and Zales is already delivering a mid-single-digit sales lift, and they're closing underperformers, up to 100 stores this year, often relocating a successful Kay store to a better spot.
Smart.
It's about being where the customer is.
So, last question on strategy. They dominate bridal. Is all this focus on fashion and LGDs? It's not they're shifting away from that?
No, it's a balance. Bridal is their foundation. They will protect that dominance. But they said fashion is underdeveloped, and that's where they see the outsized growth opportunity. So that's where the capital is going.
Okay, so let's tie this all together for you, the listener. Signet is operationally on top of their game. They fixed last year's inventory mess, they're leaning hard into LGDs to offer value, and they navigated a huge geopolitical tariff crisis.
They absolutely are. The Q3 beat proves their strategy is working. They can control their margins, their supply chain, their product mix. What they can't control is the consumer.
And that's what the Q4 guidance is all about.
It's prudent. It's realistic. It's them acknowledging they can't force people to spend money if confidence isn't there.
And that brings us back to that incredible operational nimbleness, the way they had to react to those India tariffs.
Exactly. Going from 5% to over 50% forced them to build a much more agile supply chain, practically overnight, shifting production to the U.S. and elsewhere.
So here's the thought to leave you with. If that defensive move, that emergency reaction, forced them to build this faster, more responsive supply chain, does that agility become a permanent, structural competitive advantage, even if those tariffs go away?
It's a great question. You have to wonder if a crisis forced them to create a long-term offensive weapon. If they can maintain that speed to market now, regardless of the political climate, they might have accidentally unlocked a huge enduring edge over their competition. And that could be the real story to watch this holiday season.